Hey everyone, welcome back to our channel, where we help you make smarter financial decisions. Investing can be one of the best ways to build wealth and secure your future. But let's be honest, starting out can feel overwhelming. In fact, did you know that nearly 75% of retail investors lose money in their first year of trading? That's why in today's video, we're diving into the top 7 mistakes every new investor should avoid so you don't have to learn the hard way. Stick around to the end because avoiding these pitfalls could mean the difference between building wealth and losing it all. Let's jump right into it. Mistake number 1, jumping in without a plan. Too many new investors get excited and start buying stocks or crypto without a solid game plan. Imagine going on a road trip without a map, you wouldn't know where you're heading. The same applies to investing. Example: John, a beginner investor, dumped his savings into a hot stock tip without thinking about his long-term goals. Fast forward 6 months, and that stock tanked. Without a plan, he panicked and sold at a loss. If he'd taken the time to research and develop a strategy, he could have ridden out the storm. Key tip: before investing, ask yourself, what are my goals? Is it for short-term gains, retirement, or a specific milestone like buying a house? Defining your goals helps shape your risk tolerance and timeline, so you can make informed decisions. Mistake number 2, putting all your eggs in one basket. Diversification is key. Putting all your money into one stock or asset class is like playing roulette. If it goes south, your entire portfolio takes a hit. Example: Jane invested everything in tech stocks in 2021 when the market was booming. But by 2022, the tech bubble burst, and she lost over 40% of her investment in just a few months. If Jane had diversified into different sectors or asset classes like bonds or real estate, she would have mitigated those losses. Key tip: experts suggest diversifying across different industries and asset types: stocks, bonds, real estate, even gold, so that if one area underperforms, others can balance it out. Mistake number 3, trying to time the market. It's tempting to think you can buy at the bottom and sell at the top, but even seasoned pros struggle with market timing. Studies show that even missing the top 10 best days in the stock market over a 10-year period could slash your returns in half. Example: Mark pulled out of the market during a dip, expecting it to drop further. But instead, the market rebounded, and he missed out on significant gains. Key tip: instead of trying to time the market, focus on time in the market. Long-term investing has consistently outperformed short-term trading, so stay invested and ride out the volatility. Mistake number 4, ignoring fees. Fees might seem small, but they can eat away at your profits over time. Transaction fees, management fees, and expense ratios can chip away at your returns, especially with frequent trading. Example: Sarah was investing through a brokerage that charged 1% in management fees. After calculating, she realized those fees were costing her thousands over the years. Key tip: look for low-fee index funds or exchange-traded funds (ETFs) to keep costs down. Every dollar saved on fees is a dollar working for you. Mistake number 5, letting emotions drive decisions. The market is full of ups and downs, and it's easy to get emotional, whether it's fear when the market drops or greed when it spikes. Emotional decisions can lead to poor choices, like panic selling during a dip or buying into a bubble. Example: during the COVID-19 crash in March 2020, many investors panicked and sold off their portfolios at rock-bottom prices. A few months later, the market had fully recovered, and they missed out on the rebound. Key tip: stay calm and stick to your plan. A good investor knows how to manage their emotions, especially when the market is volatile. If you need help, consider setting up automatic investments to remove emotional decision-making. Mistake number 6, not doing enough research. Blindly following stock tips from friends, social media, or even so-called gurus can get you into trouble. Without proper research, you're gambling, not investing. Example: Tom followed a YouTube influencer's recommendation to invest in a new penny stock. Without doing his own research, he bought in, only to watch the stock collapse in value after poor earnings were released. Key tip: always do your own due diligence. Study a company's financials, understand their business model, and stay updated on industry trends. Investing is part science, part art, so make sure you understand what you're buying. Mistake number 7, neglecting to rebalance. Over time, certain investments may outperform others, causing your portfolio to drift away from your original asset allocation. This can expose you to more risk than you initially intended. Example: Lisa started with a balanced portfolio of 60% stocks and 40% bonds. After a few years, her stocks had grown to 80% of her portfolio, making her overexposed to equity market risk. Key tip: Rebalancing your portfolio annually or semi-annually helps you maintain your desired level of risk. This ensures your portfolio stays aligned with your goals and risk tolerance. And there you have it, the top 7 mistakes every new investor should avoid. Avoiding these pitfalls can put you miles ahead on your investment journey. Remember, investing isn't about getting rich quick, it's about staying consistent and making smart choices over the long haul. If you found this video helpful, give it a thumbs up and subscribe for more investing tips. And let us know in the comments, what's the biggest investing mistake you've ever made? Or what's your best tip for new investors? We'd love to hear from you. Until next time, happy investing.